Welcome to the Property Business Accelerator podcast. I'm here again today with Toby Spanier, and today is an exciting episode because we're going to evaluate different models of the property investment industry and weigh each one up. We're going to talk about buy-to-lets, simple buy-to-lets, HMOs, commercial property, and also the non-AST model. So things like serviced accommodation or temporary accommodation, things that don't require ASTs. And we're going to debate, see which ones we prefer, the disadvantages and the advantages of each sector. So welcome, Toby. Welcome for coming back. Thank you for coming back again.
Always a pleasure.
And helping on the Property Business Accelerator podcast. So as I said, we're going to talk about these four topics today. And let's start with the classic, what I would call the classic residential investment model, which is the simple buy-to-let investment. What do you like about the simple buy-to-let investment?
What I like about the simple buy-to-let investment is it works over time. It's a set and forget strategy. You create wealth in two ways in property. You get a rental yield, which is the difference between your mortgage and your costs and the gross rent that you receive. That can be with the buy-to-lets. In London, 3-4%, outside London, 6, 7, 8, 9%. Kind of within that range, but you also get the capital growth. And what's beautiful about capital growth in the buy-to-let market is you don't need to do anything to the building. You just need to wait. And the property will just go up in value over time because of capital growth. So when you put the two things together, and this is what people forget, when you take a rental yield of 7% and you take a property growth of 5, 6, 7% and add them together, well, now you're talking something that is quite profitable. And you give that 5 years to run, and what you find is you can recycle all the money that you put into the property without actually having to spend any money on the property other than the deposit.
And the other obvious thing is obviously you are getting growth of 5, 6, 7% maybe on an annual basis. You know, different periods of time have been slightly different rates. However, but it's leveraged. So versus your investment and the leverage that you can apply to a simple buy-to-let, and that is obviously the case when we're comparing different models to all of them, but that is kind of the magic and what attracts people to property in the first place, I guess. For me, one of the advantages of buy-to-let is it's simple to get into, it's easy to get into, you have simple, cheap products, and it's not that difficult really. I know a lot of people over-elaborate this part of the sector, but actually, most people can easily go out and buy a property, get it rented out, and be part of the sector.
People do 1 and 2, and then they go, oh, I now need to do HMO, I now need to do service accommodation, I now need to do stuff that's sexier. And the point is, you don't. When you look at the really successful people in property, what they tend to have, although they don't talk about it, is a lot of single-let properties. Either blocks of flats or houses, they have a lot of them because they really are a set and forget strategy. It's very easy to keep on scaling. I think you said in the past, there's lots of people with 100 plus houses, but there's very few people with 100 plus HMOs, just because you get the diseconomies of scale after time. But with buy-to-let, there's just very few moving parts. It's good. The other thing I want to mention about buy-to-let is every year, the rent in the area tends to go up a small amount. So you can put the rent up if you choose to every year. What I found with my HMOs was there was a market price for an HMO for a certain type of products. You know, a non-ensuited room was X, an ensuited room was Y, an ensuited room which had a license for 2 people was Z. And that number didn't really change year to year to year. So I found it really hard to increase the rates on my HMOs. That's another strategy we'll talk about. But on the buy-to-let, you've got a fixed mortgage for 2 years, 5 years, 25 years. But you've got a rental income that's always going up. And any increase in that rental income is 100% profit.
Which means that it becomes quite incredibly profitable over time. And I feel that the power of compounding works really well in single lets for that reason. And I agree with you when we come on to the HMO sector. Like the HMO sector, I found, you know, you'd be adjusting your prices because demand and supply goes up and down. And it just seems to wait, and there was no rhyme or reason for it, but demand and supply goes up and down, and your prices adjust according to that. Whereas single lets, I don't find that same variance or that same issue You kind of know what the market rate is. It is the market rate. You can get the market rate. It doesn't stay empty for that long because there's a big demand for that sector, because there's a shortage of that sector, and therefore, and the tenancies. So another advantage for me is the length of tenancy. I look at the length of tenancy in my portfolio when I last measured it. When I measured it on my portfolio, the single it would increase every year, and it was 7-8 years was the average term of a single tenancy, whereas my HMO was more like 8-9 months. I'd say it was just short of a year on my HMO. There was a lot of changeover around the 18-month mark. Within that sort of 9 to 18 month, 2 year mark. If people stay beyond that, they tend to stay even in an HMO. But so I think also the lack of turnover is a really big plus for this model. What would you say is the downside of buy-to-let?
So I think what has changed about the buy-to-let model is the increase in interest rates from 0.1% to 5.25% is really changes the model. And the reason it mostly changes the model is all around stress testing. So when we were 0.1% Bank of England, all the lenders used to stress test around the 6% mark. We're now at the 6% mark, so they go, oh, well, let's stress test at 8 or 9%, which really is not very realistic that we're going to go up. So we've got this unrealistic stress testing that's been undertaken by the banks. And so what it means is it's actually increasingly hard to do that leverage, to get that 70% loan to value on a 2-year mortgage term. Yep. 2 years good, because after 2 years you might have bought the property quite well, done some things to improve the property, then rented it out, and there may be 2 years of house price growth of 6 or 7%. So you can see, if you buy well and get sort of compounded 14, 15% growth, you could get a 25% increase in the value after 2 years. It's not unexceptional or not particularly difficult to achieve, and that enables you to recycle your money. But you can't do that if you can't get the 75% loan to value. If the bank goes, sorry, because of stress testing, we're only going to lend you 70, 68, 65%. The economics don't work. So that's the first thing. It's harder to buy the properties because where the capital value is higher, but the rent is proportionally lower, you can't get that test to work. It seems to work well on the 150 to 200k houses with market rent, but as soon as you go over 250, 300, the economics now make it really hard to borrow that 75% for a 2-year term. You can do it on a 5-year term, but 5 years is a long time to wait for you to refinance and regain some of that capital. So I think that's one of the big disadvantages. And as a result, a lot of my coachees say, buy-to-let doesn't work anymore. I've had a look, nothing stacks. And I think part of the problem is they're just looking at the end of year 1, what is the rental yield? And they're not looking at where do they think they're going to be at the end of years 2 and year 5. When you take a longer term view on buy-to-lets, it actually, and you compare it to other strategies like HMO, it actually comes out really quite well, much more attractive.
I think that is the problem. The capital values have increased in the country. It's been going on and it's been going on, and we've obviously had a real big spurt over the last few years of capital values, which have depressed yields. We're waiting for rents to catch up. Rents are moving up, but not as fast as that capital. And then combine that with high interest rates, as you say, less and less properties are stacking. So now you have to be very particular in an area and find those lower price properties where rents don't vary so much across an area, whereas prices do vary more. So you have to pinpoint your accuracy more. But it's still possible. You and I both know it's still possible. And what I think, what we're probably going to come out of at the end of this sector, there is difference of each of these areas. But in reality, for me, there's an advanced little category into each one of these. And if you operate in that advanced category, you can make money, and you can make good money. But so I think the advantages for me, and add to this for buy-to-lets, is that it's simple, it goes up over time, you get good capital growth, you get longevity of tenancy, less moving parts, and it's that kind of set and forget model, and you kind of compounding works really nicely in buy-to-lets. Is there anything else you can think we should be adding to that positivity?
The only thing I would add is just buy-to-let is a pool of liquidity. It's easy to refinance relatively quickly. There's lots of providers in the space. It's easy to sell. It's not so easy to sell an 8-bed ensuite HMO.
Liquidity, liquidity, selling to a residential, you can sell to a residential.
And also, the last thing that people forget, there's a lot of this stuff. There are a lot of houses in the country.
Yeah.
And because there are a lot of houses, you can find a house that is valued, that is on the market for significantly less than other houses in the street, and where, if you're prepared to do some works to it, the purchase price plus the cost of works is still significantly below the average price in that street. So that's where you can get a big uplift in value. It's hard to buy an existing HMO and do that, but you can do it with buy-to-let.
Yeah, so increasing the value of it. So there are ways of increasing that simple property in value, and therefore you can recycle your money in buy-to-lets, but you need to know what you're doing there. So let's take HMOs. That's second point. Let's look at HMOs. I think, for me, I'm just going to jump in with some immediate advantages that I think you can get good money out of cash flow if you're doing it correctly. You can get some good rents. For me, the magic's around 6, 7, 8 bedrooms. If you're below that, the cash flow isn't as good as everyone talks about because of the costs and all of this kind of stuff. But there is good money to be made in HMOs. The other thing I like HMOs and the model in HMOs, from the model that I've really followed on HMOs in the past, is that ability to buy a residential house, change the planning status, get a commercial value on it, refinance, pull my money out, but also have a cash flow at the end of the day. And that difference, when I was doing this quite a while ago, there was a good difference between the resi price and the commercial valuations. You can still do that today because rents have gone up, so it can still be done today. So why I think a lot of investors like this is good cash flow, and you can recycle your cash, so you can go again and again and again and build a portfolio. Are there any other key advantages that you can see to HMOs?
Yes, one side of the coin as an advantage is that a basic HMO, a 6-bed HMO, you don't need to know any more than you need to know to buy a buy-to-let. So this is a strategy that, I don't want to use these words, but I'm going to use them. You don't need a huge amount of technical skill to do an HMO. It's just the same as a buy-to-let, but a more intensive way of getting cash flow out of a building. So people can flood into the market because they don't need to know anything about planning. They don't need to know about other advanced strategies. They can just take a standard house and make it into a 5 or 6 bedroom HMO without planning permission, without having to ask anyone's permission to do it. They can just crack on and do it under permitted development. So that's positive. The downside is, you really make money from property by using a bit more technical skill and learning your trade. And the profitable HMOs really are the 6-bed, which is quite a big house. So a bigger house is harder to buy. It's going to be a more expensive house. Or a 7 and 8 bed, which requires planning permission to convert from HMO to a sui generis status. And that is more technically difficult, involves using architects, using professional services, using planning consultants. It's not straightforward. It takes time. It enables you to commercially refinance, which is fantastic if you've got a business where you want to recycle the money. But what it also enables you to do is just borrow more money at higher rates and pay more money to the bank. So the key thing to remember is it's all about what is your cash flow at the end of the day and what is your return on capital employed. And you need to look at an HMO and you need to look at a buy-to-let. And generally I find that an HMO can deliver cash flow which is about twice a buy-to-let. But equally, you can buy 2 buy-to-lets to 1 HMO because the HMO is going to be a bigger house that costs more, and then you're going to have to spend quite a bit of money converting it if it isn't already an HMO, which is about the amount of another deposit. So you could just buy 2 buy-to-lets, 2 lots of deposits, and not do much more than that. With an HMO, you've got to buy a more expensive house in the first place because it needs to be bigger if you want a 6-bed, and then you need to spend more money converting it.
Yeah, I think if we start looking at the downsides of these HMOs, I do think I've used commercial finance very effectively in my HMO portfolio, but commercial finance is really expensive at the moment. And, if you're not careful, commercial finance can eat up a lot of that extra profit that you get out of your HMO. So, and if you've managed to really push up the capital value, obviously then you're borrowing a whole load of expensive money. It is taking out lots of the people who are getting rich are the banks on these HMOs as well. you've got to work hard to keep them full. And I think people don't always realise that. A lot of people talk about, oh yeah, but I've got tenants queuing up. If you've got the right area, in certain areas there's huge demand, and yes, that is the case. But I would imagine in the majority of areas, you have to be competitive. And if you've had them for a while, there's a lot of people who've gone out, built HMOs, and they go, oh, I know all about this. Because they've been in it 3 years. You've got to be in it. I've been, I've had an HMO for, when did I buy, 2008 or 9, I think I bought my first HMO. That's a long time ago. And I bought, so I got a lot of experience of the marketplace. Yes, it wasn't my main strategy back then, but it is hard work to keep them full, and it's hard work to keep them good quality as well, because I think you were mentioning again earlier in another conversation, there's high traffic in those buildings.
Yes.
Because there's a lot of people coming in and out. And if you get one bad tenant as well, that causes disruption, it causes chaos, all of these types of things. So, yes, there's these high-end strategies, and I love them, and you can recycle cash, and you can get high rents, and all of this kind of stuff. But there are some things to be aware of. And also, legislation from when I first started to now. I mean, I remember that everyone was really panicking because licensing was being brought in, and people going, I'm exiting the market because of licensing. Licensing has stepped up and stepped up and stepped up. Not only had more and more licensing come in, but it's also the, what you have to do to get that license. I know you sort of said, well, you can just set up a 6-bed HMO. There's quite a lot to know. Are you an area in Article 4? Licensing, planning permissions, running it effectively, and all this kind of stuff. It is a bit more complicated than the buy-to-let sector. So those are, to me, the downsides, and therefore a lot of people seem to want to be just a one-man band type property portfolio kind of person, and running HMOs is difficult, it sucks your times. Yes. Running buy-to-lets doesn't. So those are the advantages and disadvantages.
HMO stands for a house in multiple occupation, but from my perspective, having got to a portfolio of around 70 rooms, it also stands for high maintenance operation. They're just a lot of moving parts. You've got lots of people living in one house, and there's just higher wear and tear. You can outsource everything, but then you've got to pay each outsourcer. It takes time. You've got to manage each outsourcer. You've got to manage the managers. And I got to the point of going, is it worth the extra £250 of cash flow per month that this is generating for all the additional hassle, headache, and capital that I had to put in? But on the one positive side, which is why people go down the HMO routes, it's why the training companies plugged HMOs back in 2018 when Section 18, Section 24 was got rid of, is that because you've got this higher gross rents, you don't have any problem with the banks giving you 75% loan to value on a 2-year mortgage. And that kind of has driven the industry, that people can get the money, so they then do the strategy. But I kind of think that sometimes people should step back and say, not whether, the financing makes it easy to buy, but actually look at the whole end-to-end. Does this make sense over a 5-year period compared to other strategies?
I think everyone is very focused, especially those who listen to the social media, go to the trading companies, the network meetings, about recycling cash. And it is, you can do it on HMOs. You can do it well on HMOs, but the cost of that finance is expensive. So I guess there's many ticks on that side. And I do like HMOs. I think high-end HMOs really work. You recycle your cash, you can go again, and it is a way that you can build a portfolio, and you can systemize, you can build a team, and you've got the cash flow to allow you to do that. And I think, therefore, as a focus strategy, if you know where you're going with it, it is actually a very positive and good strategy to do. I think there's more and more banks coming in, there'll be more and more competitiveness. With that kind of commercial type lending, it has got more competitive over time, and I think it's going to go further. And I think products will just continue to develop in that area, and more and more banks will be driving that forward. So I do think as a market, and that type of accommodation is also coming up in popularity because it's affordable as well. So there's a lot of demand for that type of accommodation, which I think is a positive thing. So yeah, and I think the big thing, for a lot of people in a lot of people's heads around the buy-to-let is, I can't get the full loan to value out because there isn't rental coverage. So yeah, there's a big difference there.
But it is, high maintenance. it is not a passive strategy. People need to be aware that they don't want to quit one profession to create a job for them in another. And it's not necessarily recurrent income. You know, I found my income went up and down because I had voids all the time. So that makes it hard to plan, and it makes it harder to do a number of things. It's hard to get that consistency of 97% plus occupation with low levels of maintenance required month on month. Yeah.
So I think let's leave that there for the time being, and we'll come back and maybe rate them. But I think what we're starting to determine, we've got slightly different objectives, so maybe we'll have slightly different views on slightly different strategies. I do think you can build a team that runs it for you, so you need to be heading in a certain scale. I think what works well for some people are people building businesses. People building businesses that they can delegate and can probably run themselves. So they've got a bigger vision that they're going to have a lot of rooms. We're talking over 100 rooms for these people. I think if you don't get over that level, you can't build a business that makes it easy.
Yeah.
But that's a long way to go for a lot of people, and it's too far to go.
That's a lot of capital.
That's a lot of capital. So you've got to turn it into a business because you've got to raise a lot of capital. You've got to do a lot of refurbs, and you've got a machine to run in terms of the number of people that you're managing.
And you've got a cost. You've got to factor in the cost of that finance.
Yeah.
You're raising that money. Yeah. You may be paying 10%, 12% on it. You need to factor that into the deal as opposed to saying, oh, I managed to get that money from somewhere else and, oh, this HMO thing still works. You need to factor that cost in. Because it's...
But I do think if you're at the top end of it and you're running it like a business and you get to that scale, it is another good model to be in. And that's where I'm coming back to is like if you get advanced in it, you're good at it. If you're not, if you're stuck in the middle or dabbling in it, might not be the right thing to do. Could be, because you can pick a few good high-end HMOs in certain areas and maybe invest in them. Maybe get someone else. There are companies that will set up HMOs and do it like that. There's probably some good passive investments there.
I'd agree. I think I got stuck in the middle. I got to 70 rooms. I didn't have quite enough to start hiring my own person to manage it. But it was too many rooms to be able to rely on a single letting agent and have that quality of service.
Yeah. So I think it's like... all of these things, it's understanding what you need to do within each of these strategies that really makes them whether they're going to work for someone or not. Let's move on to commercial now, or semi-commercial. You've got retail and flats above or mixed unit blocks. As I say, what's your view on commercial? What would you say the advantages?
So what I like about it is 3 words, FRI.
3 initials.
Yes. Fully repairing and insuring. And what that means is that you don't need to maintain the property. You don't actually even have the costs of the insurance, although you may arrange the insurance. It's paid for by the tenants. So you've gone from this HMO where you're paying the gas, the electric, the cleaning, the TV, the gardening, the water bill, the broadbands. These costs, they add up.
And they've gone up. The cost of living crisis has really impacted HMO landlords.
Those are 7 and council tax. So those are 8 costs that just dematerialise instantly within the world of commercial. So as a landlord, commercial's good. It is really a recurrent income model. I don't like to use the word passive in property. I like to use the word recurrent. But with commercial, you can pretty much guarantee that you're going to get the rent when you're meant to get it. And there aren't really any deductions. The gross rent is your cash flow. That's, less your cost of your mortgage.
Yeah.
There's nothing else to come off. And that's different to buy-to-let, because buy-to-let you have to pay for the insurance. Insurance costs keep on going up. Whereas with commercial, you don't have any costs other than the cost of your finance, the cost of your mortgage.
So what are the downsides of commercial? I'll come and do my view on the positives and negatives in a moment. So
the downside of commercial is it's a slower moving market. There are less commercial properties, like 3 or 4% of all the properties there are commercial, a lot more residential. And because there's less properties, there's less comparators for the RIC surveyors. So there's less things that are directly comparable. One shop is not identical to the shop next door, and one shop has not sold every 250 metres within the last 6 months of every other shop. It's a much slower moving market. So because of that, it's harder for RIC surveyors to value property. And I think that's one of the reasons why you can't get 75% from any institutional lender, but you can get 70%. Even that's a push. And a lot of the bigger high street banks, they won't go above 60% loan to value. And that 60% is a capital and interest repayment vehicle. So it's financing these deals is harder. You've got to put 30% down, which is a big difference to 25. I know it's only 5%, but it does make a difference. And you don't necessarily always get that 70%. They always find a reason to go, well, it would be 70%, but you haven't got one of these, you haven't got one of those. We're only going to lend you 68%, 66%. And it just means a lot of capital has to be deployed to get control of the building in the first place. The other thing I would say is there's nothing that you need to do to the property, but equally, because there's nothing to do to the property, there's nothing you can do to the property. So with a buy-to-let, you can do this forced appreciation of buy the worst house in the street, spend some money on it, and get this big uplift. With commercial, there's nothing to do, so you can't force appreciate. And because it's slow moving, you can't suddenly increase the rents by a significant amount because the rent is set on a 5-year or a 10-year or a 15-year agreement that has been signed up to. You often inherit these tenancies and there's nothing to do but wait until the rent goes up according to whatever rules are in that original tenancy.
Yeah, so for me, again, it's an area and a sector that I think is, for me, growing in importance and significance because I do think I like these long-term leases that you can get in this sector. And however, what does put people off? Why aren't people pouring into this sector? Why aren't all the courses talking about it? It's because it's hard to recycle your cash in the same time frame as a residential, as an HMO, or as a baby buy-to-let that you do up, buff and fluff, and turn around and recycle. So it is harder to do that. But again, if you go into the advanced strategies of it, you can probably do that with that. So there are some good things because it's a set and forget strategy, which I think is a great thing. Less moving parts. You can buy on scale, you can buy size, and you've got some good yields that you kind of know what they are, and hopefully you're less likely to have bad tenants.
And the other thing I would say is it's a hedge against the AST world of tenants. So the AST world of tenants is very tenant friendly and getting more tenant friendly, which means it's getting more unfriendly to landlords. Whereas law within commercial is a business to business arrangement. Now, Osborne came in and said, letting to tenants is not a business, it's an activity. Because it's an activity, we're going to tax you differently. Can't do that within commercial because it's a business to business. And if you change the laws for this, you have to change the laws for all businesses. So the government ain't going to tinker with it. The existing law is going to remain the same. And one of the advantages of the law is that it's actually very friendly to the landlord. The landlord has a much more control over a commercial tenancy than over a residential tenancy. If the commercial tenant doesn't play ball, the landlord can basically just instantly evict them.
Yeah.
And because of that, because the commercial tenant knows that it's one strike and you're out, they don't mess around. They pay the rent on time. They make sure the rent is paid on time. And so you don't have a number of the issues that you have in the residential world within the commercial world. So for me, I quite like it as a hedge against the, to balance my residential portfolio, that if there's some very unfriendly legislation in the residential space, it's kind of okay because I've got income still coming in from the commercial space. So that was one of the reasons why I started to make the shift to commercial. We haven't talked about commercial to residential, which is basically development, and that's a way to use planning gain. And we talked about refurbing buy-to-lets. It's similar, but just on scale. That's another angle. But again, cost of materials has gone up. It's more difficult to do than it used to be.
Yeah, it's an advanced strategy to, I guess, recycle your money and in theory add value, isn't it, to recycle your money, and that's why you're doing it. Again, I think everyone gets excited by these permitted development rights when it's not always the right strategy or whatever. And I've got to do commercial. I just like mixed unit blocks, commercial at the bottom, some flats already at the top. Everyone goes, oh, what, we're converting the top uppers then? And it was like, no, just buy them already there. Why are we spending lots of time and effort and money? Because actually, quite often for residential units, they're quite cheap. because you're having to buy them on yield. People look at the whole building on the yield, and therefore you're actually getting bricks and mortar type value quite cheaply. So I think mixed unit blocks is an area. I mean, there's all what I don't want to do is open this commercial up, because there's so many different types of commercial. There's distribution, there's warehouses, there's all this kind of stuff. So we fixed to kind of high street mixed use buildings. I think they're really interesting, where you've got a bit of both. And, something that you're talking about is a balanced portfolio, is a healthy portfolio. And I think that is another message, is actually it's not just concentrate on one. Have some differences. You don't have to have everyone, but maybe think
you need to focus on one thing. You need overexposure to one asset class that you really understand, and you can manage your risk. You can mitigate your risk by specialising in that area. But once you've got to a certain size and scale, then it's like, well, perhaps those are all my eggs are in one basket. Is there something adjacent, an adjacent strategy, something that's not too different but a little bit different, that you can start building up?
So for me, I think, buy-to-let is a good place to start, and maybe you then develop into HMOs. You can start with HMOs, you can start with commercial, but you might start with buy-to-lets, often and easy. We talked in another podcast about just get that first property. It's probably going to be a buy-to-let if you're just going to go out and buy that. Just so there, and then from there you can piggyback maybe into HMOs, or maybe piggyback into these mixed-use buildings, maybe some more commercial, some shops or stuff like that, because you know what the yields are. It's fairly simple, it's fairly easy, and also the other advantage is if you've got SASs and things like that, you can utilise maybe even just the shop. If you're just buying shops, you can go out and buy some good yields in these these types of properties, and again over time they should go up in value. Obviously, you need to understand, what's happening to the high street you're investing in. Is this going to be a high street for the long term, or is this, a non-prime area is that going to continue to work, or is that something that's going to die? Are some of the other shops going to shut down, or what's going to happen, which could devalue, I guess, your shop. So there has to be an understanding of that. If they're non-high street locations, they're more secondary locations. You just got to understand that a bit, or can you repurpose them? Is there a possibility to repurpose it later, which might be an opportunity. So for me, I guess, it's the lease, it's the lack of work, but the disadvantages are some of the rates you have to borrow at and some of the loan to values you have to borrow at. So potentially more cash is required to do the same thing, and potentially sometimes it's harder to recycle.
I see commercial more akin to buy-to-let than to HMO. Buy-to-let, you've got a residential lease. Commercial, you've got a lease. It's just called a commercial lease. But it's effectively doing the same thing. It tends to be in older English, older legal English, but it is just doing the same sort of thing. So there's some slightly different terms, but the actual business model is very similar.
Yeah. And I think people get scared of commercial. People are afraid of things they don't know. And because not lots of people are out there talking about commercial property, I think a lot of people go, can I do this? Or they don't see lots of examples. Whereas if you're in the networking circles, the wider reading circles, you see a lot of buy-to-lets, HMOs, all those kind of things, and less commercial type stuff. A lot of people talking about commercial conversions, because again, they can sell courses on it. So I think there. Let's finally move on, because to what I would call, I guess, other high-flowing, cash-flowing strategies that may not involve HMOs, so property stuff that doesn't involve HMOs. So because we haven't touched on, and I guess it's been a big buzz in the last 5 years. It's gone from almost zero to hero because of the advent of Airbnb. This holiday lettings, short-term lets was a small segment of the market, and I think it's exploded.
Yeah.
I mean, it's been there forever because service accommodation has been there forever, but I think it's really come to the masses. And again, that's driven by there's better and easier finance, I think. And all these education courses has brought it up. What's your view on some of these strategies?
I think it's, again, I explain commercial as an extenuation of buy-to-lets. I think service accommodation is an extenuation of HMO. So it is more hands-on, it's more intensive. The key difference to me is it is a trading business.
Yes.
If the internet goes down, okay, for a couple of days to get it, or the boiler goes down, on a Friday, perhaps you can get the plumber out on a Monday to fix it, and perhaps no one's going to be happy with it, but they'll survive. But with service accommodation, if the internet goes down for half an hour, your business is dead if you don't get it fixed within the hour. because you'll get a really bad review online. And because of that, it means, and that percolates through everything. So you've got to be hyper customer focused to make sure your customers are happy, because in the day, now we're in the internet age, it's very easy for them to put a complaint that really affects your future bookings. So it is a lot more operational. It is running a business. It is no longer this recurrent set and forget model. That's why I see it as an extenuation.
It's not an investment business, is it? It's a hospitality business.
It's a trading business.
It's a trading business. It's a hospitality. I would see it as an extension of a hotel business. It's almost like it's a hospitality business. And actually, if you listen to a lot of people who do Airbnb, they're not interested in owning the property. They're actually just doing rent-to-rent type models, taking leases out, long-term leases, and renting it, and then onwardly, because they want the profit in between. They're operating the business. They haven't actually thought about investing in the property, buying the property. You know, if you look at a lot of people who do it in this sector, of course there's a lot of people, property investors, who do this sector too, and are focused on the asset. But it shows you in itself, it is a model that works as a trading business on its own without actually having to own the asset itself. And of course, we come from property investing, and the hotel sector doesn't have to necessarily own all the hotels it operates in. They're quite often not the hotel, the landlord of that hotel. And it's the same thing. So yes, but so therefore you've got to have, I think, yes, there's an investment aspect to it, but it's also, as you're saying, a complete business.
You get the benefits and disbenefits that you get in the HMO model, but on steroids. So you get more gross cash flow, but then you've also got a lot more costs. So at the end of the day, is your net cash flow position, your profit, worth the additional work that you have to do? Question. I also would say, is it actually in the property business, or are you now in the tech business? Because to really make service accommodation work, you need to advertise online. You start off using some kind of channel, then you work out how to use your own channel. And to make this thing work well, you need to be quite savvy at how you use technology. It's actually moving away from the physical property assets, which is how the service is delivered, to technology-enabled.
Because the experience is way more than just the property itself, isn't it? It's everything that's delivered with that, which is the smooth logging in operation, checking in, checking out, all of that kind of stuff, the booking, the marketing. So the whole thing, isn't it? Which is often tech-led. So that's what I mean. It's a business in itself that you need to understand and run. And it just so happens that it comes is a heavy real estate kind of business. Just like, another favourite of mine is self-storage. It's a similar principle, but without people. It's obviously there's a lot of property involved because you need a lot of property to do it. It's like WeWork. There's a lot of property involved, but you don't necessarily have to own it. It's a model in itself. You're creating the environments within the offices that create this stuff, and that's all that Airbnb is, or Booking.com. This service accommodation, holiday let type thing is all about that. I think it's an operating business, as you say. And you've got to be on top of the tech. There's so much tech that's now available to all of that kind of stuff.
And I would say you need to know more things in order to run a successful business. But one of the things you've got to be comfortable with is learning about the technology. So if you're not a technology savvy person or passionate about technology, it's another barrier.
But also, again, I think it's really important, if you're a property investor, I think you can run a handful of these, operating them yourself, do pretty well. But moving beyond that handful, very difficult, until you've scaled up and you've got and built a team and can afford a team. And it's a business you need to scale. But to get to that scale, there's a lot of businesses that, from small to large, there's this desert in between to get to. And I'm thinking there's that with HMOs, there's this with service accommodation, handful you can do by yourself. Or if there's two of you might be able to do a few more. But beyond that, unless you've got something else funding these people that are working with you, you've got to scale up quickly to get, and that's why I think people get into this leasing situation, because they need to scale up and get the critical mass, to get the systems, to afford all this technology, to afford the people, to be key customers to some of these people that do the laundry, the cleaning, all of this kind of stuff. So you need to get to scale quickly, which of course you can't if you're just investing in the property.
Exactly. So if you look at buy-to-let, all the products is the property. There isn't anything but the property. If you look at service accommodation, property is an important part, but it's by no means all of the service. The service is all the stuff that happens before they arrive at the property and stuff that happens after they leave the property.
Yeah, and as you say, you've got to act on it instantly if there's any problems and have the systems in place to do that, the call centres, the 24-hour service, concierge, all of this kind of stuff. So it's almost like, to me, I say to people, it's like running a hotel, but your rooms are disparate across the city. So I think it makes sense if you're taking blocks of buildings and doing it, because you've got that scale and it's a bit easier, isn't it? And all of that kind of stuff. You've also got the freeholder worries. If you're in leases, on leaseholds and leases, you've got freeholder worries. So again, buying a block to do something like that, I think works quite well. So I think it has its advantages because it can make a lot of money, but you've got to go into it with your eyes open. So for me, it works again if you do it at scale. You've got to be active. You've got to set up a fantastic business model and be slick at systems. And actually, it's the introverted, systems-orientated people that are probably going to run better service accommodation businesses than the people who you think would make great hosts, who are the extrovert people type person, but are not so good at systems. So it's actually probably the tech kind of system-orientated people who set up great Airbnb businesses, which is kind of probably counterintuitive a little bit. And then you've got other models in there. I think temporary accommodation, those kind of things, renting to social housing, so hands off. Go and rent to a big organisation who's going to take your HMO, your single let, and look after it for you. So I think there's another way of scaling HMOs. You get pissed off and annoyed with that. Find someone who's going to give you a good lease, good long-term lease. It's going to be above the single let. Probably it won't be as much. Sometimes it is, but it won't be probably as much as renting out the rooms individually yourself. But you can earn a good income from it. So I do think that's a good model and becoming more and more popular in the marketplace. So that gets a big tick for me. You have to understand it. Obviously, don't want to put all your eggs in one basket, I would say. So if you have a social housing provider, don't just go to one in case something happens. I think also there could be a shock if legislation suddenly changed and everyone goes, oh, but this is all government backed. I don't think it is.
There is no security of supply. And that's why it can be hard to get the financing for service accommodation. That's why some lenders say, show me 1 year of your accounts, so I can actually see what occupancy you're running at, which never happens with HMO or buy-to-let. It's like, this building's let. They don't say, well, what if everyone moves out? They just assume that no one will move out.
Yeah. So, and I think that's important, isn't it? Because lending in commercial and on buy-to-lets, and actually HMOs, it's done on the power of a piece of paper. The piece of paper is a contract between the occupant and the landlord that says, I promise to pay you this on a regular basis, and therefore there is a secure certainty about future income. That's not the case with temporary accommodation, non-AST stuff. It is if you've got a guaranteed rent from if you've given a long lease to someone, but then you need to check with your mortgage lender. You need the right finance associated with these long leases, because it's getting into commercial territory again. So you might need more commercially type finance for that. But it's about past performance, isn't it? It's how funders fund businesses and stuff. They look at past performance. Have you been profitable for a while? Are you likely to be profitable? What's your experience as a person like? Then we'll give you the lending. There are products developing now that are coming out, I think. So this market, I think, is only going to get more equipped in terms of finance, in terms of not temporary accommodation, in terms of the short let, service accommodation marketplace.
And I would say that you're seeing the regulation coming in. It's going down the line of HMO licensing. So we've got this C5 planning status that's come in Wales, that's going to be moved out into the UK for short-term lets. So now people know what this thing is, because before people didn't know, was it a hotel, was it a B&B?
Yeah, what is the planning status?
So with this regulation, what happens is the market then catches up. And then the mortgage market creates products specifically for.
That's right.
So actually the regulation is a good thing, because it creates a supporting infrastructure and ecosystem around it.
But also it's probably going to limit supply, because there is a big thing about, we talked, the shortage of housing. And if you're taking stock out of the housing pool and into the short-term hotel pool, with serviced accommodation, not all authorities and towns and government want you to do that. So I think it's going to be harder to do these things because it is restricting supply. It's why things like London have a 90-day rule. You can only short let for 90 days on a property.
And we've got taxation changes.
And that's why they've changed the taxation because it wasn't included in the Section 24, was it previously? It is now. So I do think this is going to mature. It's going to change. It's going to develop this sector. But I do think the planning is going to be a big, big thing for this sector coming forwards. And I looked at this like 6 years ago, just when Airbnb was starting to hit. And I just thought legislation could wipe out your business. Now, maybe I should have scaled up, built a business and sold out of it, but because it's taken a lot longer. But I was always a bit concerned. And when the 90-day rule came in, it could, if you were in London on a service accommodation business, it could have wiped your business out pretty quickly overnight when they became strict with it. And in a lot of boroughs it was there anyway, and people didn't realise. But it is one of these things that legislation can tear a knife to and cut through your business, and then you're done. So that was always my concern about Airbnb. Still is my concern about Airbnb.
It's been the Wild West for a time, and it takes a while for the government to catch up.
Yeah.
So it probably had 10 years of people kind of operating on the fringes, but now you can see the direction of travel, and it's going to come in. It's just going to be like HMO licensing. It's going to make it not commercially viable at the smaller end. It's going to, force some people to sell up and professionalise, and the same thing that's happened within the HMO market.
So where for you, now let's summarise where we are. So what are you, if you were going to have to pick one, where are you in this scheme of everything?
So I think it's really important to understand you and understand what your character is, what your passions are, and you can do all sorts of different property strategies, but you need to find the one that kind of suits your character best. And for me, I'm a bit of a technophobe, so I don't really want to go down the serviced accommodation, running a hotel type thing. I'm not brilliant at budgeting refurbs, so I don't want to go down the heavy development side, because whenever I do it, I always end up spending more than the budget. I kind of like the set and forget, and I like kind of having a vision for how a property is used that perhaps no one else has, and creating the value at the front end in how I structure and negotiate the deal with the vendor. So for me, I've kind of gone from HMO to buy-to-let. Interestingly, I built this portfolio of 70 rooms without acquiring a single buy-to-let. And so I've gone back to where people normally start, which is a buy-to-let model, but a bit supercharged. So my buy-to-lets now aren't just one house, they're blocks of flats. So there's economy of scale there. So for me, it's the buy-to-let strategy supported by commercial, but the commercial really is a hedge on having all my eggs in the residential basket.
Yeah, for me, there's a little bit of a journey. I would say a journey, and you probably start out in the buy-to-let sector. Although you said that you did a lot of HMOs. I think in your story you said that you probably did have a buy-to-let, or you inherited a buy-to-let, so generally that's what happens. Buy-to-let. Now some people stick there and never develop on from there. Absolutely fine. But I think then there's a journey, and people seem to go into HMOs to improve cash flow. I think really you need to improve your cash flow a bit, get some good profitability into your business, and then you can go on to sort of bigger projects, bigger things. And that elevates you up into what I would say advanced strategies. And if I'm looking at columns of strategies here, buy-to-let, HMO, commercial, Airbnb type businesses, I'm thinking quite often actually, once you've got a bit of experience in any of these columns, you want to be at the top. And as long as you're at the top in your advanced sector, and as you were saying, well, you've gone into buying blocks, then that's where you are. And so for me, you probably go from buy-to-lets, maybe into HMOs to help you move up in knowledge, experience and refurbs and everything, maybe into mixed-use buildings or blocks of flats, which to me could be an advanced strategy of actually single lets anyway. And then maybe you want to tack on a bit of income by understanding serviced accommodation or temporary accommodation or a high income strategy or social housing or something like that. And I think it's quite often where you have two combined advanced strategies is where you get a really sound, robust, great, again, you're combining these multi-unit blocks with creative finance at the moment and these creative buying. So I think it's that top end. So really, for me, we've compared each sector and it comes down to the individual's requirements, needs and goals, I think, as to what is right for them. Each one has its pros and advantages. But if you want to become a big landlord, property business that is, a proper business, you need to be up on that echelon of using these advanced strategies so you can continue to expand your business, run your business, and have a very profitable, high margin business. And that for me is where I think the success currently lies. And in any market, that is going to work, whatever the interest rates are.
What I would say is most people in property have come to it as a second profession. They've worked somewhere corporately, they've achieved a level of success. It's your model, it's my model. They get some spare cash that they want to invest and they think about property. Not that many people go straight from university into property because you kind of need to have a bit of cash to get going. And so because of that, there is a skill set that you've developed in your former job in corporate, and you should use that skill set, the bit of it that you enjoy, for the flavour of property investment that you want to do. So if you're passionate about tech, then perhaps the service accommodation model works well for you. If you're great, I used to do cost models all the time, so I like doing the spreadsheets, the structure, the deal at the front end to work out how can I make this deal work really well for me and also well for the vendor. So that's the bit I focus on. And people sort of forget that they've had a career, they've done things that have become easy to them that are very difficult to other people, and they need to remember that, because just because they find it easy doesn't mean it's not valuable. And if they take that and apply it in property, they have a source of competitive advantage. But often people go, oh, I'm doing something totally different. What I've done in the past is now irrelevant. Let me go on a training course and just do this one thing and ignore the fact that I find it really easy to do this thing, this thing, this thing, this thing, and this thing, which would make my property investment process much more
What's
successful.
your uniqueness? What's your own USP? Bring that to the table and understand where that fits within the property circles. I think it's a very good piece of advice to do. I know the more I've embraced my own kind of USP, values, etc., then to me, that's where it becomes easier to do property and you also enjoy it far more. If I'm stuck in creating systems, necessary evil, then I'm not enjoying that so much. Doing creative deals and seeing the visions that other people can't see because it comes easy to me, I fully enjoy and therefore love and have that passion for property. And I think you're the same. You found your area of flow. It's working really well for you.
But it's taken me almost 6 years to find my niche. But I'm glad I found it now.
Well, I
had to go through things that I really didn't enjoy to get.
And I think a lot of people do. And I think that's, I think the key nugget to take out of this, if people are listening to this as to what sector should I go into, is yes, there's lots of pros and cons into each one. And yes, you can make each one work. Which one's going to work for you? But as I say to everybody I talk to and help out in property is like, where do you want to be in 10 years' time? Make sure whatever you're doing and whatever you're pursuing fits in with that. Don't worry if you don't land on it immediately because it takes some time to build and understand what you want. You've got to try different things sometimes and you will get there. And then when you do get there, that's when you'll fly. And I think with you, if you look back over your journey, it's been the last few years, as you say, when it's taken you a while to get there. But since you have got there, wow, the amount of property you've taken on board, the amount of income that's come in, the amount of equity that you're creating for yourself in the future is 10 times what it was previously. So I think getting that flow is going to be a really good. I think that's a sound piece of advice from yourself, and I think But also the other thing I think for me as well is don't jump around too much.
Shiny penny syndrome.
Don't have that shiny penny syndrome, and it's not always what everybody is rushing towards.
The grass is not greener. The grass is just fake.
So anyway, I still think property is a good thing to do. I think there are certain things that have made it a little bit harder, but overall, it is still a very lucrative and profitable thing that you can get involved in if you know what you're doing, have the right approach and go
Absolutely.
to an attitude. And everybody in property needs a can-do, problem-solving type mentality, because there's always problems in property. So on that note, I think we'll finish today's episode of the Property Business Accelerator. So if you enjoyed the debate today, please put comments below as to what you think is the best sector. And also, please don't forget to give us a follow and a like, as it helps the algorithms and boost the show up. And hopefully you will be interested in seeing more interesting property debates in the Property Business Accelerator podcast.